So Warren Buffett started investing at age 11 and is now 91 years old. That's 80 years of investing experience, which, let's be honest, makes him a expert at investing. So after combing through hundreds of different articles and interviews, here's what I found from Warren Buffett, the man that got rejected from Harvard, who'd go on to make $14 million per day. We'll cover exactly how the billionaire investor himself would tell you to invest and how he has been so successful for so long. So if you were curious about what Warren Buffett first invested in when he was 11, he actually got 6 shares of City Service Preferred, which is a natural gas company.
To that day in 1942, because it was the day you purchased your first stock. We should point out you were 11 years old then.
Right. Said to my dad, I want to go all in. I had $125, and I put every bit of it in 3 shares of City Service Preferred, and which is still my personality, is to shove it all in.
As we've seen with Apple.
Yeah, somewhat.
However, the stock doesn't matter as much as the fact that he bought 3 shares for his sisters at $38 per share. That investment he gave to them would later on help shape their entire financial base in the world. And now a little background. So Warren Buffett is an American business magnate, investor, and philanthropist with a net worth of about $125 billion. Considered one of the most successful investors of all time, Buffett now runs Berkshire Hathaway, which is a multinational holding company that's invested in tons of big names like Apple, Bank of America, Coca-Cola, and American Express. If you want to know how successful of an investor he is, just take a look at this chart that compares Berkshire Hathaway's total return to the S&P 500 for 20 years. Clearly, he's one of the most knowledgeable people out there when it comes to investing. So with all that being said, let's dive into some things that we can all learn from Buffett. There are a lot of things we can learn from his mistakes, his successes, and most importantly, the actions that he took early on to get most of his net worth today. The reason why I say that is because if he had not built the financial base that he did when he was younger, he would not have the billions that he has today. But why does it matter if you start young or old? Well, it's because of something called compound interest. You've probably heard of it before, but it's basically the interest that you earn on interest. It's what allows small amounts of money to grow exponentially over time, and it's the reason why he was able to beat out Jim Simon, who had a 66% annual return compared to Buffett's 22% return. Because Buffett started investing in the 50s, he had a 20-year lead on Simon, which resulted in a 72% net worth difference. So what can we learn from this, right? Well, for starters, if you're already past 11 years old, you should probably start investing because chances are you are already late to the party, just like I was when I started after college. I mean, compared to Warren Buffett investing at 11, I think we're all starting a bit too late. Oh, and Warren Buffett would love a platform like Public.com, who's graciously sponsoring this video. Public is an investing platform that helps people be better investors. With Public, you can build a diverse portfolio of stocks, ETFs, cryptocurrencies, and soon even alternative assets like NFTs, art, and collectibles. As you can see, building a diversified portfolio is important for investors like Buffett. Public makes investing super easy and convenient. There are $0 commission fees on standard stock trades. They also have over 30 cryptos alongside thousands of stocks and ETFs. This includes the most popular cryptos like Bitcoin, Ethereum, and Cardano, and they're always adding new cryptos to the platform. For example, they recently added ApeCoin. You can follow me at public.com/Charlie and see what trends I'm following, and you'll also get a free slice of stock between $3 to $300 when you make an account and deposit. Again, that's public.com/Charlie to get your free stock. I'll see you there, and now back to the video. But the key to this isn't just investing early, it's also developing a deep understanding of what compound interest is capable of. Once you understand compound interest, you'll realize that Buffett's investing strategy is not about the high annual returns or the amount of money he made in the last year, but more about how much he has made over a long period of time. In fact, you can see this play out when you look at the 5-year chart, as Berkshire Hathaway actually underperformed compared to the S&P 500. I'm sure you guys have all heard of the term time in the market versus timing the market. And well, this is exactly what the term is talking about, because instead of trying to make the most money now, you just have to keep investing for longer to beat everyone else. Now, before you even spend $1 investing into any stocks, you first need to know about what Warren Buffett looks for in a company that he's interested in. Let's take a look at how Buffett and his business partner, Charlie Munger, approach investing through a set of simple philosophies.
And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your level, defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value.
We have to deal in things that we're capable of understanding. And then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage.
So what can we learn about them? First up, you need to study the business, not the stock. You should not let the price of the stock affect how valuable it is, which is why Buffett advises anyone to learn the business. Take Tesla stock, for example, right? If you don't know much about electric cars, will you truly be making an informed decision investing in a stock like Tesla or NIO? Next, does the company have a durable competitive advantage in its market? This is referring to the company's moat, or what I like to call blue ocean. If the company has an advantage over the rest of the competition, it will be able to raise its prices without too many consequences. We'll be talking more about this in a little bit. But last up, as a bonus, let's take a look at something Buffett said back in 1999 in a shareholder meeting that I think is super interesting.
You find small securities in your area of competence that you can understand the business. I think you can, and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, that there is an opportunity to earn very high returns.
What I want to focus on in this clip is how he talks about finding small wrinkles in the market. What he's trying to say is to find stocks that are currently being mispriced. Sometimes there are times when stocks have major sell-offs, and that creates a window of opportunity for active investors to take advantage of. But how do you know if a stock is being mispriced? Well, two of my favorite ways are by looking at their price to earnings and price to book ratio. A PE ratio measures the company's current share price relative to its earnings per share, meaning if it has a lower PE ratio, it's considered to be undervalued. Many investors will say that it's better to buy shares in companies with a lower PE ratio because you would be paying less for every dollar of earnings that you receive. So in other words, buying at a discount. Now, a PB ratio compares a company's market price to its book value, meaning if its PB ratio is under 1, then your stocks would cost less than what the company can, theoretically sell for. This for investors can mean that the stock is undervalued, but it could also mean that there's something fundamentally wrong with the company. Now, Buffett's methodology in finding low-priced stocks also evaluates things like the company's return on equity, debt-to-equity ratio, and profit margins. A return on equity is often referred to as the measure of profitability in relation to equity, which basically means how efficiently the business generates profits. This is a really important financial ratio because it helps us understand how a business uses its money. So Warren Buffett, he looks for stocks with a higher projected ROE of at least 15% because that indicates that the company is more efficient at generating profit. You'll also want to look at the ROE over the course of 5 to 10 years to see if they are getting more efficient, because that would also be another really great sign. Now, the debt to equity ratio is the total liabilities divided by shareholders' equity, which basically tells investors if the company is using more of equity or debt to fund their assets. A high debt level compared to equity can result in volatile earnings, so Buffett actually prefers a company with a debt to equity ratio that is below 0.5. In other words, for every $10 in equity, the company should only have $5 in debt. This would indicate that the growth is being generated more from shareholder equity instead of borrowed money. And last, we have profit margins, which are the company's net income divided by the revenue. Having a high profit margin suggests that a business is doing well, but if you want to find growth, you should also look for increasing margins. This would mean that the company is super efficient and successful at controlling their expenses. And according to Buffett, companies with a gross profit margin of 40% or more tend to have a competitive advantage over companies below 20%. So with all these ratios and numbers to keep track of, it's important to know that finding these opportunities nowadays is going to be more difficult. Let's hear what Charlie Munger has to say about it.
I would also say that what we did 40 or so years ago was in some respects more simple than what you're going to have to do. We had it very easy compared to you. It can still be done, but it's harder now. You have to know more. I mean, just sifting through the manuals until you find something that's selling at 2 times earnings, that won't work for you.
Over 60 years ago, Warren Buffett and Charlie Munger would flip through books to find a stock that was undervalued. And I bet that there weren't many people doing it at that time compared to today. Because today everyone has access to stock analyses online, but That's not to say that there aren't any opportunities out there to buy underpriced companies. As Buffett said in the shareholder meeting, if you can find these wrinkles in the market, they can give you an opportunity to get significant returns. Now that we know what he looks for in stocks, let's take a look at Berkshire Hathaway's holdings in 2022 and how they all fit into his investing approach. If we go on the Berkshire Hathaway portfolio tracker on CNBC, we can see that some of Berkshire Hathaway's biggest holdings are Apple, Bank of America, Coca-Cola, American Express, and Kraft Heinz. If we take a look at all these stocks, what do they all have in common? Well, they are all companies that have competitive advantages in the market, which allows them to raise prices without losing out on customers. Let's look at their biggest holding right now at 43.5%. Which is Apple. Berkshire Hathaway began buying Apple stocks in 2016, and after 2 years, they already had a 5% stake in the iPhone company. If you look at a company like Apple, it doesn't matter if they all of a sudden charge extra on their products because it's not like we're going to stop buying them. Buffett clearly sees Apple as an essential business for consumers and businesses all around the world, with loyal customers willing to pay a huge premium for their products. Let's also take a look at how this investing approach applies to Berkshire Hathaway's investments in the banking industry. Out of the top 10 holdings, the 5 bank companies are Bank of America, American Express, Moody's, US Bancorp, and Bank of New York Mellon. So why does Berkshire Hathaway invest so much into banks? Well, consumers and businesses rely on central banking institutions to do business and keep the economy running, making the banking industry an absolute necessity for most people. Even if we look at Berkshire Hathaway's most recent investment into the domestic oil production company, Occidental Petroleum, we can see that oil is another business that most people will pay a large premium for because they have no other choice. Especially with the conflict between Russia and Ukraine, domestic oil production has increased, and as a result, prices skyrocketed over 43% in February. Now, what you shouldn't do is just go buy any of these stocks right now just because Warren Buffett did. He's never owned any stocks that he didn't understand, and that's why I always recommend that you guys do research before investing in anything. Buffett knows that there are stocks that he doesn't fully understand, so he stays away from them until he can learn.
There are all kinds of things I don't know about. And that may be too bad, but why should I know all about them? I haven't worked that hard on them.
Now, at this point, you might be wondering about inflation and how the Fed just announced that there will be 3 interest rate hikes in 2022. Due to a wide range of political and economic factors, inflation has been at a record high, reaching up to over 8%. For consumers, essentials like gas and food may become unaffordable, and businesses may have to cut production costs or increase prices for the consumer. Things are definitely more scary for investors during times of high inflation and rising interest rates. So what do you do? Well, if you remember one of the things that Charlie Munger talked about, it was to find a company with an enduring competitive advantage, basically a moat. Berkshire Hathaway is already investing for inflation as they have tons of shares in companies that have competitive advantages. The moat that these companies have lets them protect their market shares against inflation. But what else does Buffett recommend when it comes to inflation?
The best protection, the best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents. And if you increase your talents, they can't tax it while you're doing it. They can't take it away from you.
So what he's saying in this clip is to invest in yourself and build your own talents and skills so that you can afford the increase in prices. Not many people think of it that way, but I think it's super important as an entrepreneur to build skills because no one can take that away from you. Now, for investing during times of rising interest rates, we'll have to take a look at the 2021 Berkshire Hathaway shareholders meeting.
Interest rates, basically are to the value of assets what gravity is to matter, essentially.
So what does Buffett mean when he says that interest rates are to stock valuations what gravity is to matter? Well, think of it like this. If you try to lower the amount of gravity, you will be able to jump higher. And if you increase gravity, it'll be harder for you to jump as high. So because interest rates have been so low for the past 2 years, stocks have seen a ton of jumps in valuations. But now that interest rates are rising, we might see stock valuations come under pressure. Now, this is by no means to scare anyone, because if this does happen, it'll actually be a good thing. If interest rates continue to rise and inflation runs hot, we'll be seeing money move out of the markets and back into bonds, meaning stocks will be at a discount and it would be a great time to invest. However, it wouldn't matter in the long term because, like Charlie Munger has said before, you don't make money when you buy and you don't make money when you sell. You make money when you wait. Now, I want to end this off with something Buffett said during the 2018 Berkshire Hathaway shareholder meeting about how much you'd have if in 1942 you invested $10,000 into the S&P 500 and never looked at it again.
You had invested $10,000 and you put that money in an index fund. We didn't have index funds then, but you in effect bought the S&P 500 and never looked at another stock quote, never listened to another person give you advice or anything on the sort. I want you to think how much money you might have now, and we'll get the answer. You'd have $51 million, and you wouldn't have had to do anything. You wouldn't have to understand accounting with a very relaxed philosophy, and you do not have to know as much about accounting or stock market terminology or whatever else it may be, or what the Fed is going to do next time and whether it's going to raise rates 3 times or 4 times or 2 times. None of that counts at all, really, in a lifetime of investing. What counts is having a philosophy that you stick with, that you understand why you're in it, and then you forget about doing things that you don't know how to do.
So if you're watching this video and you want to know how to invest in 2022, all you really have to do is ask yourself one question. Do you see the American economy and businesses growing in the next 50 to 100 years? If the answer is yes, then it's really a no-brainer, and you should invest in companies that you understand, that have a moat and can easily scale. If you don't want to spend the time looking at different companies, you can do something that Buffett also recommends, which is investing in low-cost index funds, such as ones that track the S&P 500 index, so that you can buy all these big companies in one single stock. You don't need to be good at accounting, you don't need newspaper headlines, and you don't need to listen to people from Wall Street telling you how you can beat the market. Remember, Warren Buffett is the guy that had a net worth of $39 billion in 2010, but now has a net worth of over $120 billion, something that is only possible from starting as early as he did. That's over a 200% increase in the last decade, and it's because compound interest grows exponentially. That means that if you want to passively invest like Warren Buffett, you need to just continue to invest even if inflation is high and interest rates are rising. Be patient, and more importantly, be consistent without trying to time the market. As long as you continue to invest over a few decades, you'll be taking advantage of compound interest and creating long-term wealth with Warren Buffett's investing model. Anyways, I hope you guys got some value out of this video. Making this video is super fun. Watching all these clips about Warren Buffett was actually super interesting. And yeah, the guy really is an investing genius. And yeah, if you liked the video, make sure to hit that like button and also subscribe for more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.